Texas Lutheran University.
Thank you everybody for being here. This is the fall presentations for Bulldog Investment Company. Bulldog Investment Company was started 9 years ago as an on-campus internship to utilize the strategies and techniques that have made Warren Buffett so successful over the last 50 plus years. Since inception of the program, all of our students have had real hands-on experience, not only breaking down financial statements in the manner that Warren Buffett would, but also actually managing an investment portfolio. Everybody always wants to know how that portfolio has done. Year to date, they've done better than 11%, which has been very admirable, but more importantly, through good students throughout all the years and all the graduations, their portfolio has compounded at better than 14% a year. I don't think that very many of our students are actually going to go to Wall Street and become professional money managers, but every one of them is going to work for an entity that produces financial statements. Every one of us has to know how to interpret those financial statements so we can give effective feedback to management as to this is good, this is bad, this is somewhere in the middle. That's not only effective in communicating with management, but your coworkers, your vendors, everybody in the value chain. So we think that this program adds a lot of value. It is something that is very hands-on. These students dedicate a huge amount of their time to be here every Friday afternoon without fail. So that said, thank you for being here. Let me turn it over to our first group, Malarkey Capital Management.
My name is Zachary. I'm a senior finance major. This is my second year in Bulldog Investment Company.
My name is Tasha Phillips. I am a super senior accounting major in the 5-year master's program, and this is my 5th year in Bulldog.
My name is Andrew Leal, business management major, currently a junior, and this is my first semester in Bulldog Investment Company.
My name is Drew Studdard. I'm a senior management major. This is my second semester in Bulldog.
My name is Anna McCluskey. I'm a second year accounting major, and this is my first semester in Bulldog.
So we are Malarkey Capital Management, and we will be presenting Infosys today. So just a quick synopsis. Infosys is headquartered in India. They are a technology services and consulting in the technology services and consulting industry. We have a current market cap of $33 billion with return on equity and return on capital both historically above 20%. Current price to earnings ratio is 15.7 with a price to owners earning of 17.2 and a PEG ratio currently at 1.1. So just a brief history. We were founded in 1981. In 1987, we opened our first international office in Boston. And in 1993, we had our initial public offering. In 1995, we introduced our e-business practice, and I'll talk about that later. In 96, we created our Infosys Foundation, and we accomplished CMM level 4 in 1997. This is basically just us being able to go in and actually create data management and solutions for clients. And this is one of the highest ranks that you can have. In 1998, we started our enterprise solutions practice. In 1999, we reached our first $100 million in revenue. And we also accomplished CMM level 5, which is the highest rank you can get. And at the end of that year, we were able to open up our Infosys business consulting services. In 2000, we reached $200 million in revenue. And by the end of that year, we launched Finacle, which is a universal banking solution that we still use today. And in 2001, we reached $400 million in revenues, and the next year we reached $500 million in revenue. By 2004, so just 2 years later, we reached our first $1 billion in revenue, and only 23 months later, we reached $2 billion in revenue. So in 2006, we celebrated 25 years of being in the industry, and in 2007, we saw our first CEO change, so the COO became the new CEO. And a few years later, we reached $5 billion, so in 2010. And then since 2011, 2014, we've seen 2 new CEOs come in, and we've had the current one for 3 years now. And in 2015, we acquired 3 businesses, and I'll talk to those in a minute. So our key acquisitions for this past year, in March of this year, we bought US-based Panaya for $225 million. So this is a technology automation service that basically focuses on large-scale enterprises and basically taking their current databases and their software solutions and basically just making it more automated and more convenient for the business. Some of our customers include Coca-Cola, Walmart, Sony, Mercedes-Benz, and a couple others. And so in June of 2015, we bought Qualitative, which they have a software called Scava, and basically that allows us to do digital experiences, meaning that when you go shop online, when you go to, say you're looking at a shirt or something, when you go to click on the image, it actually makes it to where you can rotate the image, look at it, and get a feel for it without actually being in the store. And they do offer in-store solutions as well. Some of our customers include Macy's, Kohl's, Bloomingdale's, and some more. In August, we transferred our Finacle business, so this is our online banking and basically everything that has to do with banking solutions, to a subsidiary of ours called Edgevert, and this took place in August of this year. And Edgevert currently serves 17% of the whole entire banking population worldwide. In November of this year, we bought Noah Consulting LLC for $70 million, and this is giving us a foot into the oil and gas industry. So now for our business. So what do? Simply put, we're basically we go out, we design, test, analyze, advise, and treat business solutions. And basically we do that through these 5 founding principles here. We do engineering, application development, knowledge management, business process management, and outsourcing services as well. So our business model in the industry pretty much goes like this. You have product developers, you have product consultants and installations, and then you have your end user. And so essentially, IBM, Oracle, SAP, Microsoft, they create a product or a service, and then people who need to install it, the IT department or whoever, that's more or less where we fall in. And so there's 4 or 5 big names in the industry, Infosys, Accenture, Wipro, Cognizant, and a few others. But essentially, we go into the business and we take that product and we install it for the customer, and then that basically leads us to the end user. And so that's more or less how the business model is. So how do we make our money? Our revenue recognition basically works like this. So if we look at our beloved Warren Buffett, so say he has a problem with his computer, he wants to install some new software, he can't do it, a little old, not really with the technology. So he calls up Infosys and basically asks, hey, I need y'all to come over and install this for me. They'll come over, and if it's a one-time event, if they're just going to do it the one time, that's a fixed price thing. So you can basically assign a price to that one-time event. Now, if it's going to be some sort of, I want to go on some sort of reoccurring revenue with you, or reoccurring business with you, whether it's data management or customer service or whatever it might be, that goes on a fixed time frame. And so basically, you're able to assign a length of time to that contract, whether it's recurring or whatnot, but that's how that works. And so the fixed aspect of our revenues is about 40% of our business. And our third type of revenue recognition is time and material. And so this is essentially a little bit more tricky in the sense that there's not really a deadline to these projects. It's essentially if Warren wants us to come in and create some sort of new technology that hasn't really been invented yet, then we'll come in and basically say, well, we'll work with you. We can't set a deadline for it. It's going to be trial and error kind of thing. And then you kind of, as you kind of make leaps and bounds within the project, you kind of recognize revenue that way. And so that's actually 60% of our revenue, and we're trying to get more efficient with that. The time and material revenue is not the most efficient, and so we're actually trying to become more efficient and go into more of the fixed pricing strategy. So for our business segments, they're pretty straightforward. We pretty much operate in 5. This would be financial services and insurance, manufacturing, high technology, energy and utilities, retail, life sciences, and healthcare. So respectively, these financial services account for 33%, manufacturing 22%, energy and utilities 20%, retail consumer, packaged goods and logistics 18%, and lastly life sciences and healthcare at 7%. And these make up our revenues per segment. And so if we look at this on a year-over-year performance, we can see at the top the life science healthcare. That's actually been the one that's grown the most for us year over year. So we went from $541 million to $722 million in that segment. And so that was a 33% increase year over year. Our retail consumer goods went from, call it 1,300 million and to 1,500 million, so a 16% increase. And then our energy and utilities, we had a 14% increase. manufacturing a 17% increase, and lastly, financial services a 16.5% increase. And so, all in all, our revenue totals grew from 2015 to 2016, 17%. And so our business segments by geography, most of our business does come from North America. 66% of our revenues come from North America, 22% come from Europe, 3% come from India, and 9% comes from the rest of the world. And so, again, if we look at this as a year-over-year performance, we grew in India the most. We actually grew 26.5% year to year. And for the rest of the world, we grew at 13 to 14%, Europe 12%, and North America almost 20%. And so again, we went from revenues of we grew revenues at 17%. So our client base, so our total clients as of the end of last year or this year was 1,136. And so from last year to this year, we added 325 new clients. And there was a loss of a big client of ours. It was the Royal Bank of Scotland. However, we didn't lose the Royal Bank of Scotland. We lost the potential of what might have been a new contract. So the Royal Bank of Scotland was going to have a subsidiary that was going to basically potentially bring in $200 million for us. But because of Brexit and other factors, they didn't decide to go through that project. And so we lost that subsidiary. We didn't necessarily lose the Bank of Scotland itself. And so 97% of our business is actually repeat business. And our top client currently is Bank of America, which accounts for 3.6% of our revenues. Our top 5 clients overall contributed for 14% of our business, and our top 10 clients contributed 23%. And on the right, this graph just basically shows where most of our clients by size is. Obviously, you can see most of our clients are smaller, meaning they're less than $1 million in total revenue to us. We have a couple more as we go down the line, but most of our business is derived from anywhere from $1 million to $50 million in revenue. So our corporate governance, so Dr. Vishal Sikka, he's the CEO who came in 2014. He has basically he's had a lot of industry experience. So he worked 12 years for SAP, one of our rivals. He was on the board for 5 years out of that as the CTO, or Chief Technology Officer. He received his bachelor's degree from Syracuse University and his PhD in computer science from Stanford University. So he's obviously very well put together in the industry. Pravin Rao is our Chief Operating Officer. So he joined Infosys in 1986. And what's interesting going back to our Chief Operating Officer, he's our first non-founding officer, meaning that basically if you weren't in the business from 1981 on, you basically weren't an officer. So he's the first person to come out of coming out of Infosys. So anyway, moving back over to Pravin Rao, he oversees basically all the global operations, and he's held 5 leadership roles within Infosys. And what's neat, though, is that the current CEO and the current Chief Operating Officer, they're actually seeing eye to eye for the first time in a while. Before that, the CEOs that had been changed before that, they hadn't really seen eye to eye, and so it seemed kind of like the goals were misaligned. But in many talks that they give, they seem to be set on this combined goal of reaching revenues of $20 billion by the end of 2020. And so we currently have revenues of $9 billion, and so that's going to be a pretty stout increase. So they want $16.5 billion in traditional outsourcing, basically the majority of our traditional business. $1.5 billion to come from future acquisitions, and $2 billion in newer areas of technology. This would be automation technology, et cetera, et cetera. So for our employees, as of March of this year, we had 195,000 employees. We added about 17,000 new hires, and these people come from India, mostly India, but they also come from United States, United Kingdom, Australia, and China, pretty much exclusively. And so for education and training, I didn't know this. I kind of thought you just kind of went in and started working. But it actually takes 6 months to get fully trained to actually start working for the company. So basically you go in, and they call them campuses. You have to move to these areas, whether it's in India or wherever it might be, live there. It's basically almost like a university. And so you have to work there, live there, learn the material, and whatnot. And so if you compare us to IBM, so IBM only takes 3 months to do this process. And so we try to emphasize it a little bit more. I guess we emphasize it in different sectors, which we take a little bit more time. So that's this. So for our economic moat, we basically have high customer switching cost, just like IBM or Accenture or anybody else who we're familiar with. If you're going to go to Infosys, it's not going to make a lot of sense to switch over to another competitor, just because once you're on our platform, you're going to have to relearn, the next best customer's data, their customer service, how it works, and so on and so forth. And so, if you look at our revenue retainment for the past several years, we've had 97% revenue that are repeat business. And so we've also continually added 200 plus clients a year. So as we add more clients and as they become more loyal, this just makes our moat even stronger. And now I'll hand it off to Andrew.
So we're going to talk about risk factors. The first one we have listed is industry transition. And like we said, our industry was primarily human-based services. Now we're seeing the move over to automation and artificial intelligence to lower operating costs. So next we have price pressure here, and our industry is very competitive for price. Like he said, we have 97% repeat clients, so our pricing needs to be very competitive in order to maintain the clients we already have, and then to go out and obtain new clients. With operating costs, the wage costs for employees in India is usually much lower than the wage cost for employees in America and in Europe. So primarily we use Indian engineers, Indian employees. Now we see increased wages in India coupled with rising H-1B visa costs in the United States. So that cost of being able to use the cheaper engineers and employees we have in India is now starting to level out. So we are looking at hiring more American and European engineers, which is in turn going to raise our operating costs. But we hope to combat that with our AI platform. We'll talk about that more in a little bit. So next we have Brexit. Everybody knows what happened with Brexit, with the UK leaving the European Union. That affected us, like Zach said, with our contract with that bank, but also it ties into currency exchange rates. So the rate of the euro and the dollar are starting to fluctuate and decrease, and we are going to have to, in turn, cover that cost, because with our pricing pressure, we can't increase costs on the consumer side. We might lose those clients. We might not be able to maintain those clients. So growth opportunities, like I talked about with our AI platform, Mana, we've already implemented it into our systems, and we were able to reduce operating costs through this automation of 2,387 employees worth of work. So what that essentially means is this AI platform is replacing what 2,387 employees would be able to do by itself. So we're going to use this to combat our operating costs, and it looks very promising. The next thing we have here on growth opportunities is our Citigroup contract. So Citigroup right now is looking for a contract to manage their back office administrative operations. Citigroup's last contract was worth $2.5 billion. So it'd be a great opportunity for us if we were able to land this. It's going to be announced March of 2018, and we're one of the companies in consideration. So like Zach talked about our continued acquisitions, the more companies we're acquiring, some of them offer different services or maybe go into different segments. So by acquiring those companies, we're broadening our scope of our services that we have available. And we're also going to be able to capitalize on their R&D and some of the things that they're doing and use those expenses. So government contracts, we currently do not have, we don't operate with government contracts. We don't have contracts to manage government systems, but that's something that we're looking into in the future to expand our business further. So we're looking into government agencies and different government contracts like that. So I'm going to go through our qualitative analysis. Commodity or sustained competitive advantage, we do have a sustained competitive advantage. It's in high switching costs. Like Zach said, once you have our systems in place, it's really just not worth it to switch out of us to a competitor. Like we said, we also have, again, that 97% reoccurring business from our clients. Is it easily explainable? We debated on this quite a great deal. We ended up saying no, but with an asterisk. So we understand that we're not a Coke, we're not a Walmart. It's a little bit harder to display what we do and have you understand it, but we can explain it in that we understand we offer services, we understand we give those services, and we're paid for those services. So that part is not easy to understand, and that's why we have an asterisk there. We're not unionized. We do not have heavy capital infusion R&D. For obsolete services, we answered yes. This was also conversation, but technology, our field is ever growing. It's always changing. The technology we used when we started in 1981 is not the same technology we use now in 2016. The same technology we use now isn't going to be the same technology we use in 2030. So technology is ever changing. So those systems and whatever we put in place, that inventory is obsolete now. Our services were obsolete, but we're going to continue to grow like we have been, and we'll continue to see that growth. We do not have any chronic one-time write-offs. And for the question of can you make a competitor with $1 billion, we vote to say yes. We also have an asterisk there. So we produce about $9 billion in revenue annually. So if you started a company to compete with us for $1 billion, you would come in as a smaller company than us. So one, you could be servicing smaller clients than we service, in which case, maybe we can't reach that small client, so that's a good thing. We're not worried about that. Or two, we couldn't work together, similar to the way we work with IBM and some of their services they provide. We work together and we provide our services. So no, yes, you could make a competitor with $1 billion, but no, we're not worried about it. And now Drew's going to talk to you about the interpretation of financial statements.
Now we'll talk about the interpretation of financial statements. As you can see, over every single metric, trailing 12 months, we passed every threshold. Our net income trend has been increasing. Our retained earnings trend has been increasing. And an important thing to point out is that our obligation ratio is at 0 because we do not have any debt. And now for the graphs. Here's revenue. Revenue has been steadily increasing for the trailing 12 months. Our gross profit margin, as you can see, it has been declining. This is a result in an increase of employment costs. And these were contract labor agreements, and Infosys is now beginning to extinguish these, and so we expect this to level out. Our net income has been increasing. Our profit margin has been decreasing. This is a result of revenues growing fast, our expenses growing faster than our revenues. Here is return on equity. Return on equity has been decreasing. Our retained earnings has been increasing. As you can see, in 2015, we had a drop. This was due from, we were paying a 40% dividend payout ratio. In 2015, we added this by 10%. So now we pay a 50% dividend payout ratio. Our average diluted shares outstanding has remained relatively consistent since 2008. And here's our historical trends. This is going, all the graphs that we had just shown, we had been increasing, staying consistent. As you can see, we have 4 decreasing metrics. And so to point this out, every single decreasing metric remains above our threshold. And also, when you compare it to our competitors, we remain well above our competitors and the highest in our industry. And now Anna will talk about value bands.
So value bands are a way of valuation, how we value a company, comparing its current value over its historical value. So there are various colored lines. Those are percentiles. If it is at the 70th or 80th percentile, that means a company is overvalued. So if it is in the middle between the green and yellow lines, a company is determined to be fairly valued. And if it is at or below the green lines, a company is undervalued. So at 8% of its historical rank, price to sales is undervalued. Price to owner's earnings is also undervalued. And price to earnings less cash follows a similar trend. Price to earnings is undervalued at 19% of its historical rank. And price to book is extremely undervalued at 3% of its historical rank. So price to cash flow would be considered fair value since it's in the middle, and it is at 46% of its historical rent. Price to free cash flow is similar, and it is also fairly valued. Enterprise value to revenue is undervalued at 8%. And enterprise value to EBIT, or earnings before interest and taxes, is also undervalued. So here's the industry breakdown. These are some competitors of Infosys in the industry. For our operating and net margin, we are above our competitors across the board, and we also have an obligation ratio of 0 because we have no debt, which is amazing.
Alrighty, I will talk to you guys about the DuPont analysis. What the DuPont analysis does is allow us to break down a company's return on equity into 3 different metrics: the net profit margin, the total asset turnover, and the financial leverage multiplier, to see where it's deriving its return on equity from. So as you can see, over the past 5 years, from the bottom going up to the most current 2016, it has remained above our threshold of 15%, so that is exactly what we like to see. Comparing the DuPont analysis of Infosys to its competitors, you can also see that it is not the highest. However, the 2 remaining that are higher than Infosys, their return on equity is mostly derived from the financial leverage multiplier, which we believe to be a negative thing because it could mean that they're too heavily leveraged with debt. So now we're going to go into the conscious investor, which allows us to look at a historical period of time and the growth rate between its earnings per share and sales per share, and look at the growth rate between those years and the stability to estimate what our return on the investment would be. So as you can see, we're going to look at the most recent 3 years from 2014 to 2016, and that growth rate for our earnings per share was 8% with a stability of 98%, while the sales per share for the past 3 years grew at 7% with a 99% stability rating. So with those 3 years, past years of growth, Conscious Investor allows us to see what the rate of return would be if that was indicative of the future of Infosys. So with that, the default line shows us what that would be, and it would be at 10% rate of return. Now the safety line allows us to hit the company hard to see how bad the economy or the company would get before we start losing a rate of return. So we cut the PE by 27% down to 13.3%, down to 13.3, and we cut the growth by 31% down to 5%, and we cut the payout ratio down 6% to 30%, which would give us a 5% rate of return with the past 3 years of growth. So now we're going to look at the past 7 years of growth with a similar trend in mind. So the past 7 years of earnings per share growth has been 7% with a 96% stability, and the sales per share growth has been 10% with a 96% stability as well. So in the past 7 years with those growth metrics, we can expect a rate of return of 9%. Now if we were to cut the PE by 27%, cut the growth by 19%, and cut the payout by 6%, we could expect a rate of return of 5%. So now we're going to try to kill the company even further. We're going to cut the PE by 5%, and we're going to cut the payout completely, as if the company was not doing very well and they had to stop giving us that dividend, and that would give us a rate of return of 2%. So we're going to kill the company even further to see how bad it would be before we stopped making a return. And that would be cutting the PE by 15% down to its lowest PE in the past 7 years, and cut the growth by 45% down to 3%, and then kept the payout at 0. And that would give us a 0 rate of return. So that is how bad how bad it would need to be before we stopped losing a rate of return, or sorry, before we stopped getting a rate of return. So now we're going to move on to the discounted cash flow model, which allows us to look at the current price of the company and grow the company into the future 10 years, and then discount it back into the future 10 years at a specific rate, and then discount it back to today's rate to see how safe this investment would be. So the discounted cash flow gives us a default based on Guru's current metrics, and they have a 93-cent earnings per share, which is the current earnings per share, and they grew it at 16%, which was the past 5-year average, and then they discounted it to 12%. And that would give us a 32% margin of safety, which is good, but we don't believe that that's indicative of the future of Infosys. So we made more conservative estimates. So we brought the growth rate down to 11%, which is management and Value Lines estimates for the next 5 years. And then we dropped the discount rate down to 10% because this is how much you could expect to get if you put your money freely into the market. And we don't believe 12% is that accurate. So we'd like to be more conservative. And with these metrics, we would get a 17% margin of safety. So the reverse discounted cash flow sees at what rate the company would need to grow for us to buy into the company right now and it be fairly valued. And that would need to be 8%. And that would give us a 0 margin of safety. And as you can see, we haven't grown at 8% for the past 5 years or 10 years. So the intra-portfolio evaluation puts Infosys into our current portfolio to see where it is amongst our other holdings. So looking at price to sales, we can see it is near the bottom half of our current portfolio, but earnings per share is near the top half, indicating a undervalued position. And price to book is similar to the price to earnings trend. Now I'll pass it over to Zach to close it up.
So, as Warren Buffett's always said, price is what you pay, value is what you get. So I'm going to assign a valuation to this company. And so what we're doing here is essentially, if we look at the current valuation of the company, so the current multiple of the company on the top line, for our different metrics, we'll leave it at that. But if we look at our value bands, what Anna showed us, if we can figure out what our 20% multiple should be, we can try to assign a price to it. And so if we do that across the board for all of our metrics, if we do 20% rank of 3.68% for price to sales, and if we multiply it by our per share figure of 4.4, we'll get a price for that metric of 16.92. And so I'll save you the boring part of doing it. So if you do it across the board, we'll eventually come up with a buy price of $14.21, and our current price is $14.31. And so with the conclusion, we do recognize that it's a transition period. We're going from a more human-based platform to more of an artificial intelligence platform, as we've talked. And but we do recognize that they are undervalued and that they do have a strong economic moat, which comes from their customer switching cost. And with that said, we would like to conclude this presentation by recommending a market order for Infosys. Thank you.
Mr. Zarodka, fire questions away.
Where's this company headquartered at? I don't know if you guys ever said.
Bangalore, India.
India. Can you walk through pros and cons of the company being headquartered in India?
So an immediate pro is that, so they kind of switched between headquarters over the past 30 years, but they've come back to Bangalore. And so essentially India has these safe, I want to call them safe zones, that's not the word, but essentially it's a tax shelter. And so if you're in these locations that offer these tax shelters, for the first 5 years that you're doing business in that region, you get 100% of your income is tax-free. So you don't have to pay taxes on that 100%. You don't have to pay taxes on that amount that you bring in. The next 5 years, so 10 years out, you have to start paying taxes on 50% of that. And then 5 years after that, so now 15 years, you have to pay 50% of that 50%. So 25%, you have to start paying that. And so after the 15th year, you have to start paying the full tax rate. So we're actually approaching that 15th year since we've been in Bangalore. And so that's a con. We might lose that tax holiday, as they call it. And so our current tax rate's about 20, 21%. And so I don't know what the tax rate would be if we lose that tax holiday, but I would assume that it would come up a little bit. So that the pro is the tax shelter. Con would be we might lose that tax shelter. The con as well would also be the fact that a huge portion of our business is based in the United States, and so India is an emerging market. I would hope that, with that said, they start creating more businesses that need our services. But with the strong dollar, it might be cheaper for Indian-based businesses to actually do work with an American-based business instead of paying an Indian-based business, because it might not be economic that way. So that could be a con.
How about your employees? How many of Infosys's employees come from India or Indian residents?
So Indian, I'm not sure.
I did not find that percentage.
Talk about,
of
it's
how
a
many.
majority.
It's a majority.
Majority of them do come from India, yes.
Yeah, that was because of the lower cost of wages in India as compared to the United States. But with what we talked about with the raising of the visa costs and also the cost of wage costs in India is increasing, that's why they're looking at more. They're going to hire more American engineers.
Okay. You want to go down?
Sure. So at the beginning of your presentation, I wrote a question down, and that was in reference to how the company was doing. You had that slide with the different segments and showing how each segment had grown from 2015 to 2016, and they were all double-digit rates, 10% plus for every single one of those. And so my original question was, is this going to be sustainable in the future? How do you see this changing and why? But as you got to the end of your presentation, there was a conscious investor slide, and those were all single-digit growth rates for sales and earnings on over a 3 and 7 year period. So I'm hoping you can reconcile the two for me and then opine where you think growth is going to go from here.
I would hope that, well, they have announced a share buyback plan, hopefully within the next 2 years. So if that happens, obviously that would create value for us as a shareholder. That would essentially grow us. But as far as growth going forward, I mean, there's going to be a lot of cost efficiencies coming with the automation. I mean, the Mana, it's not essentially Watson, but it does perform similar tasks in the sense that the artificial intelligence can basically do exactly what a human can do. That'll eliminate cost, that'll eliminate basically expenses that would grow our margins, and then obviously, I mean, Wall Street loves to see higher margins, and so as that happens, that should help us as shareholders.
As far as reconciling conscious investor to the previous earnings percentage, I don't have an answer for you. We did find discrepancies within conscious investor with some of our other metrics, like the payout ratio, so I'm not sure where they're pulling those numbers from, but I guess that kind of goes back to we need to interpret the information that it's giving us, not just take it blindly. So I don't have a solution as reconciling those two numbers.
Okay, and then one more opinion. So the CEO is on the books saying that he wants to double the revenues in 3 to 4 years. So, you know, with your answer in mind, do you think what they're doing right now is reasonable? Do you think they'll be able to get there, and how?
I think it's reasonable considering their revenue trend in the past 10 years. I think bottom line, the margins I think they need to figure out better ways to improve their margins, but I think the revenues, I think it is sustainable considering the past trend in the past 10 years.
I mean, as we've kind of said this several times now, I mean, we're getting rid of low margin businesses and less efficient businesses, and as we basically move into more automated side, I mean, I feel like 11% growth rate, and we've actually changed our growth rate estimates twice this year. Infosys has. It was at 13 to 15% at the beginning of the year. It dropped to 12 to 13%, and now it's currently at 11. And so, I mean, listening to management, they say it's hard for them to project these numbers in the sense that it is a changing market. And so you can listen to it, and they basically say this is our best guess as to what our earnings growth could be is 11%. And so, I mean, if they've had to cut it 3 times down to 11%, I feel like the lowest they might go is anywhere to 10%, 8 to 10%. And so, I mean, even with that would get us pretty close to $20 billion by the end of 2020. And so I feel like that number is not out of the ballpark entirely. I feel like it's attainable.
Thank you.
So over the history of Infosys, they have actually issued shares, which is not too unusual with a growth company. But they obviously, as they have really hit their stride, they have not been buying back shares. Do you think that not buying back shares is a good policy? If they are going to buy back shares, should it be done through internal cash flow, through debt, or something else?
So since August 2016, so their year end is March March. So they actually did start buying back shares in August of 2016. So it wasn't shown on the graph just because that was March year end. But I think that they didn't they didn't buy back shares in the past because I think they were focusing on growing and more of that nature. But I think now that they're maybe looking to a brighter future, they're using their cash to buy back shares. I don't think they're going to do it in form of debt. I don't think they're going to take on debt to buy back shares because that's not what it's looking like so far since August.
So I'm going to start the conversation. She's an accountant. She can probably help me out here. But right now we do have a lower tax rate because of this tax shelter. And so if we lose that tax shelter, I feel like if we either bought back shares or issued dividends or did a bond, the tax rate would be, it'd be best to do it closer to now than just wait because the tax
Yeah,
rate.
because then we're not going to have as much cash left on it.
Well, no, because the tax doesn't, sorry, I have a conversation. The tax rate, like, pay tax rate as opposed to some of the dividends. So if it's cheaper now, shoot it now than wait. That's what I'm saying.
Mm-hmm.
Anyway, so that's what I was saying. So it'd be cheaper if we did it now than wait. And so I feel like it would be a good use of cash if we issued a dividend, if we bought back shares or issued a bond in the current state because of the tax rate.
Issued dividends or took on debt?
Took on debt.
Okay.
Go on debt.
Okay. Andrew?
You talked about the percentage of your business that comes from different parts of the world. Is that where your customers are domiciled or where the revenues are actually occurring? And what I mean by that is you've got some pretty large customers that operate internationally. So when you have 66% in North America, is that North American companies regardless of whether they're operating, or is that just business in North America? Because it seemed like there were some pretty big areas of the world where this kind of business activity is going on that weren't represented there. So is that because the activities, that breakdown that you gave is where those companies are domiciled, not necessarily where they're earning the revenues?
Right. Most of these companies were realizing the revenues where they're domiciled, and so we were doing business with Noah Consulting, the business we just acquired. They do majority of their business in Israel, and so we were actually realizing the revenues from them through the United States. And so most of the business that we do is through the domicile business.
John?
Andrew talked a little bit earlier about currencies when he mentioned the Brexit. Can you guys just talk about what you've seen maybe in the annual reports or the quarterly statements on whether currencies are helping them or hurting them, and talk about the currencies that they have to deal with? Because if they have a lot of employees in India, I'm assuming they're paying those employees in Indian rupees, and it looks like they're getting, like Andrew just touched upon, looks like they're probably getting a lot of their revenue in US dollars. So does that help them, or have they been hurt by currencies?
It has been. Last year it hurt them. And another risk that is associated with currency rates is that if they get any gains from that, it automatically goes to the Indian government. It's like a federal law. So that's also kind of negative. So even if it does help them, they have to repatriate back to India.
Okay, interesting.
So, but last year it has hurt them.
Okay. Do you know by how much off the top of your head, or no?
Each
For every point that it appreciates or depreciates,
it affects
it affects us about 0.5%.
Yeah, 0.5%.
In
Okay.
So I don't know in total, but that's her point, I guess.
Okay. One of the other things I saw at the beginning of your presentation, like Nate said, in the kind of chronological order of things, I noticed there's been quite a bit of change in the CEO position. Can you just talk about why that position has had such high turnover in the recent past?
I feel like, so Watson was introduced around 2009, 2010, and so if we look at the back of the chart, our first CEO change consecutively happened in 2011. And so I feel like the industry was starting to shift more towards automated services, and I feel like Infosys kind of was at a misalignment of corporate governance, like where we wanted to stick versus where we wanted to go. And so I feel like the conversation basically was there wasn't an alignment on the board. And so finally, I feel like our new CEO, Dr. Sika, I feel like he is actually online with the rest of the board. And it seems like they all come to pretty much the same agreements about where they want to go. I've listened to 3 or 4 conferences, and they pretty much just rant about this 2020 figure. And so, and a lot of that is going to be due to the automation. I mean, that's pretty much where they put on money right now, is that managed service. And so I feel like prior to that, it was probably based on just the more human technology side of the business, whereas that was probably not going to be the best one forward. They would have got left behind in the industry.
Okay, next.
So, you did a good job presenting the case for Infosys. The majority of your presentation I felt was pretty upbeat, but it's been beat up actually significantly over the last several months. It's down from $19 a share to about $14.50 right now, which as a percentage is fairly significant. So can you give us a little insight as to why the market hates Infosys right now? What are they frustrated about? What are investors, what's going on?
We have had a decrease in margins that may be a result of that.
Yeah, I noticed that. And ROE. You commented about employment costs
Right.
are going up, or maybe was it you?
I did.
Yeah, you mentioned employment costs are going up, so that could contribute. Is that going to change? What else?
Yeah, I think okay. So I think first of all, the market's probably down, and because of the margins, they may not be looking at the revenues or the net income increases, just the marginal decreases. The CEO change, I think, is an issue, and I think if people are getting into this industry, they might want to go for the big dog, which is IBM. So I think but we're not really worried about that because we service a different target market. So we're okay with that. But I think when people get into this industry of investing, they think big dog, big picture, not necessarily Infosys maybe. So I think those kind of hurt Infosys, but I think in terms of the decrease in margins, I think they're doing all the right things as far as going to automation, cutting off employee costs. I think things like that's helping.
And also too, I feel like, as Andrew said, it's not an easy business to explain. And so I feel like the Infosys is being probably misconstrued as IBM. It should be doing the same things that IBM is doing. It should be doing Watson kind of services and whatnot. But we're not the same business. Like, we don't create the products and software that similar to IBM would. We basically do the installation of it, the servicing of it, and whatnot. And so I feel like the growth rates and the product development is going to be quicker than the growth rates in the installation and commercial side of it, consulting side of it. And so I feel like the market might be saying, well, why aren't you all hitting these 20% growth rates, whereas other businesses might, and we're falling short on that. That could be it. I mean, I feel like it's one of those businesses that's just, it's not easy to understand, and so the market doesn't understand it, so they just feel like, well, if the technology industry is booming, why aren't you booming, kind of thing.
So the market doesn't understand and it's overreacted, is what you think?
Potentially.
Markets are rational.
So kind of following up on this concern about the slowdown, you have identified that their growth rates are slowing down, but have you been able to identify where the slowdown is coming from? Is it coming from a decrease in sales, a decrease in efficiency? Is it currency, or is it something else?
It's an increase in expenses, and so our expenses are right now growing faster than our revenues, and so that's making our margins obviously appear lower. But I mean, that kind of makes sense if we look at Bed Bath & Beyond, our most current kind of fuss about in our portfolio. They're going through these huge changes to basically get into more e-commerce and more online-based businesses, and so we're kind of doing a similar thing, and so we're going to take a hit for a period of time and then come out of it. And so our growth rate isn't going to be astronomically high anytime soon, I don't feel like, until we get rid of those lower margin businesses and we become more cost efficient with automation and getting rid of the more human capital side of the business.
We got an audience question.
What's that?
We got an audience question.
Mr. Thompson?
Coming along behind Dave's question, at least in my mind, do you have a sense of what's at the core when Infosys loses a was good, I thought. One of the things, and this maybe ties to the winners and losers, is I couldn't figure out where this savings in labor manifests itself. You know, I've never run a company that size, but in my company, if I know I've gained some money somewhere, I usually share a little with the customer and put a little in my pocket. So where does Infosys put that extra money that they save on labor? Or does it ever show? I mean, it's a real thing. It's a big number they save on their labor. So where does it come out?
So these basically operate like universities. They have over 180 different campuses, if you call them. And I mean, it's literally they pay for your food, they pay for your education, they pay for your every cost of living you can associate it with. And they're doing this for 194,000 employees. I mean, sure, there might be 50 or 60,000 at a time that are going through these campuses, but I mean, that adds up real quick. And so if you cut back on the cost of that, that's where some huge efficiencies should come from. Just from the...
I can see how it'd be hard to know.
Yeah.
But if I were CEO, I would want to understand that.
One, I think with the money, you talked about, you're wondering what they do with the money that they're saving. They're starting up employee benefit programs now with the employees that they are keeping. So that's one way that they're using the saved money, I guess, to give back to the employees that they are keeping. But yeah, as far as the other stuff, it may not show specifically.
So going back to my first question, when you lose a customer, is there any understanding of why you lose a customer? Historically, I see it's cost, poor job, speed of reaction. Sometimes it's even integrity.
I mean, going back to our client base slide, most of our clients were generating $1 million in revenue to us. And so these are companies that are typically going to be, not necessarily startup companies, but they're going to be companies that just want, like if Warren Buffett wanted his computer fixed, it's like, I want my computer fixed, or I want something that's going to be secure and safe, but then they're like, maybe I can hold off, maybe I need to buy some equipment or something, and so that kind of gets pushed aside. And so I feel like if you have smaller clients like that, where the bulk of our business comes from, that could be something that happens. I mean, maybe the customer literally is just saying, hey, that can be pushed aside, I can wait. And so we haven't had too many, I mean, we've gained 300 people per year for the past.
Okay, well, let me flip it over then. If we're not too sure about the ones we lose, how do we win the new ones? I mean, if you're winning, don't you want to know how?
Yeah.
Man, I'd want to know, how did I win that one? I mean, I want to know how many I'm winning, but I want to be able to duplicate it. I want to be able to do it again.
Right, it's basically, so if you're a business, I'll just say, for example, if you're TLE or if you're a school or something, and you get started, you're gonna have to have some sort of infrastructure. And so you're either gonna go to IBM or Oracle or whoever it might be, and then basically we come in, we're like a package deal almost, we come in with them. And so we do have a sales aspect of our business where we have to go out and get clients, but most of it is tied into the fact that we are, IBM calls us a premier partner. So we are partners with these companies, and so it's kind of rolled into the package of Oracle or IBM or SAP or whoever it might be.
And I don't know for certainty, but I feel like a lot of it is reputation with these clients, because it talked about the rapport that they have with those 99% recurring customers and the history that they have there. So I think maybe a big portion of it could be on reputation of how they gain new clients. But I can't say that for certain.
Okay, thanks.
You. John or Nate, any final questions?
I'll throw out one more question. How does Donald Trump becoming the next president of the United States impact Infosys, if at all?
Well, we talked about immigration, with those rising visa costs, it's going to be harder if we were choosing to use Indian engineers and employees to bring them over here to use them, with that increase in visa costs and the crackdown on immigration. So, I mean, that's the quickest answer I can give you of what I think, how that would affect us.
Okay. Does that put you out of business, or does it just hurt you pretty bad?
It just hurts us. I don't think it definitely doesn't put it out of business. We're already looking at starting to hire more American and European engineers and employees.
could potentially be a growth opportunity if he does end up building that wall and he needs some sort of, engineering or something. Gotta hire us.
Okay.
Nice plug.
On that note, why don't we give him a round of applause?
Hello, we are the Berkshire Babes and Hathaway Hunts. I am Stephanie Thompson.
Kristen Howard.
Audra Bart.
Austin Speed.
Chase Dawkins.
And today we will be presenting CVS Health.
CVS stands for Consumer Value Stores, and they were founded in 1963 in Lowell, Massachusetts. Most of their growth, historical growth, has been through acquisitions. But in 1994, they launched PharmaCare, which was their first pharmacy benefit management service. More recently, in 2013, they acquired Dragario, which is a pharmacy chain in Brazil. In 2014, they acquired Quorum, which I'll talk about later, and Navarro Discount Pharmacy, which is the largest Hispanic-owned pharmacy in the United States. In 2015, they also acquired Omnicare and Target's pharmacies. The acquisition of the Target pharmacies increased their retail pharmacy store count by about 20% and their clinic store count by about 8%. CVS is a massive company. They serve 5 million customers per day and fill about 1.9 billion prescriptions each year. So that's actually about 1/5 of all of the prescriptions that are filled in the United States. CVS is also one of the only pharmacies that has a business-to-business segment and a business-to-consumer segment. So their two main segments are their pharmacy services and their retail and long-term care segment. Their pharmacy services are mainly, they have both business-to-business and business-to-consumer transactions, and the retail and long-term care is primarily business-to-consumer. Most of their revenues come from their pharmacy services segment. I'll talk about now. So these are all of the different branches of their pharmacy services segment. Accordant provides integrated disease management for over 17 different medical conditions, and they're adding more conditions that they're going to treat. Novologix is a claim processing software system, and Advanced Care Scripts is the specialty pharmacy branch of Omnicare, and Navarro Health Services is another specialty pharmacy that they own. CVS Caremark is their primary pharmacy benefit manager, and they serve over 75 million members, and all of their members can use Caremark services at 68,000 different retail pharmacies and 27,000 independent pharmacies. Not all of those pharmacies have the CVS name. Can you go back? Yeah. The two major services that Caremark provides are Maintenance Choice and Pharmacy Advisor. Maintenance Choice makes it much more convenient for the patients because they have the option to either pick up their prescription in the store or have it mailed to them for the same low copayment as the mail order pharmacy. Pharmacy Advisor is primarily used for patients with chronic conditions like heart disease and renal disease and diabetes, and it gives them access to a pharmacist who will speak to them face-to-face and give them advice and clinical support that they need. And Pharmacy Advisor has actually managed to increase the adherence rates and medications by 4%. So, and overall, if you want to go to the next slide, CVS Pharmacy's adherence rates are on average about 6 percentage points better than their peers for many of the chronic conditions. So as patients adhere to their medications, they're less likely to have strokes and heart attacks, which would cost the insurance companies a lot of money. And so by increasing the adherence rates, CVS actually saves money for their insurance company clients. So these are all of the services that CVS provides. Pharmacy benefit managers generally act as middlemen between the pharmacies, the drug manufacturers, the insurance companies, and the customers themselves. And they negotiate prices with the drug manufacturers and come up with better ideas or better deals for the insurance companies. And CVS is unique in that they have their own PBM. A lot of the other pharmacies have to pay another company to do their pharmacy benefit management services. And CVS also will advise the different insurance companies about which drugs to include in their formulary lists for coverage. So two of the biggest insurance companies who are CVS's clients are Aetna and Blue Cross Blue Shield. They also do services for sponsors of health benefit plans, including the managed Medicaid plan. They actually have a 19% share of the managed Medicaid market. SilverScript is CVS's Medicare Part D subsidiary, and they actually cover a total of 11 million people in the United States. It was also the largest prescription drug plan to achieve a 4-star rating. And SilverScript is actually the third largest Medicare Part D provider in the country, behind Humana and United Healthcare. And Humana and United Healthcare have what's called a preferred cost-sharing system, which means that their customers can only get their prescriptions filled at certain pharmacies and still get the Medicare Part D coverage. Now, SilverScript is the largest open network Medicare Part D program, which means that their customers can get their prescriptions filled and have their Medicare Part D coverage at a bunch of different pharmacies, including Walgreens, actually. CVS also operates the largest specialty pharmacy in the country. Specialty drugs are drugs that are used to treat chronic conditions like diabetes and heart disease. Generally, they don't sell as many of those drugs, but the profit margins on them are much higher. The two specialty branches are Specialty Connect and Quorum Infusion Services. Specialty Connect is a lot like Pharmacy Advisor in that it provides guidance and clinical support to the patients and who have these chronic conditions. And a lot of times for those patients, it's extremely hard for them to know when to take their medication and how to, get the drug and everything. So Specialty Connect addresses all of those issues in getting the specialty prescriptions. Quorum is an infusion and enteral services provider. So they deal with catheters and like IV injections. Quorum also has it's also the largest home infusion network in the United States. So they will actually go to your home and provide those infusion services, which makes it more convenient and for the customers, and it makes them more comfortable. Also, they offer peripherally inserted central catheter placement services, and those are utilized in cancer treatments. This is a map that shows all of Quorum's locations. The red dots are their retail infusion sites, and the blue dots are just their regular branch locations. So their pharmacy service revenue is divided into mail choice and their pharmacy network revenue. Their pharmacy network revenue comes from their specialty pharmacy revenue and their regular retail pharmacy. But that does not include maintenance choice. But the mail choice revenues comes from maintenance choice and Specialty Connect mainly. And most of their revenue comes from their pharmacy network. And now on to the retail and long-term care segment. On-site pharmacies are pharmacies that are attached to a freestanding clinic. And these are the other branches of their retail segment. So most of their retail revenues come from the sale of prescription drugs, followed by the sale of over-the-counter drugs and personal care items, as well as general merchandise. CVS Pharmacy actually has the number 1 or number 2 market share in 93 of the top 100 U.S. drugstore markets. And it's located in every state except Wyoming And they also have ScriptSync, which is a program that helps people who have multiple medications that they need to manage. It helps them it enables them to pick all of those prescriptions up on one date, which makes it more convenient, and with increased convenience comes increased adherence rates, which will save money for CVS's insurance company clients. Also, CVS has the largest rewards program out of any of the other pharmacies, and it's called the Extra Care program. They also offer over 6,000 unique store brand products. CVS Health makes generic drugs, and Gold Emblem makes snack foods. They have everything from makeup to nail polish, and they also have lots of nice skin products as well. They are also they have the largest number of clinics of any other pharmacy. So their Minute Clinic is staffed by nurse practitioners and physician's assistants, and they diagnose and treat minor illnesses and injuries. They'll also do health screenings for blood pressure and body mass index. They'll give vaccines. They do different injections like prescription birth control. And all Minute Clinic visits are covered by more than 250 different insurance companies. Over half of the United States population lives within 10 miles of a Minute Clinic. So once again, it's very convenient for people to go there, and they have over 1,100 locations. In their long-term care segment, Omnicare is the main subsidiary, and they have a very big network that will support their long-term care. Omnicare is actually the leading pharmacy provider to nursing homes and other chronic care settings. Basically, the difference between when they're filling regular prescriptions and when they're filling prescriptions for these long-term care settings. In the long-term care settings, they're required by law to have all of pills in a sleeve, and each pill is in like a little individual punch-out sleeve, which makes it much easier for the elderly people and their care providers to manage their drugs. 80% of Omnicare's patients live within 5 miles of a CVS pharmacy, so chances are those prescriptions are going to be filled at CVS. Advanced Care Scripts is their specialty branch. In recent news, TRICARE, which is the Department of Defense's insurance company, decided to drop CVS and replace them with Walgreens due to a network change. CVS historically has filled 25% of TRICARE's prescriptions, so they're expecting to lose $2.2 billion in revenue and about 40 million prescriptions, but they said that it would only impact their earnings per share by around 2%. And their revenue growth opportunities more than compensate for that loss. So these are the main growth drivers that management listed on their website. They said that there will be an increased demand for prescriptions due to the aging population. And they said by 2025, the number of people age 65 or older is supposed to increase by 38%. And 70% of those people can expect to use some form of long-term care. So not only will they be filling more prescriptions, but they also have opportunities to grow their Omnicare revenues as well. Caremark has historically grown quite a bit, but they also expect it to grow more. Over the last 7 years, the number of managed and dispensed prescriptions that Caremark managed increased by about 62%. And in the last year alone, they added a total of $12.7 billion worth of new clients to their pharmacy benefit management services segment. Also, Maintenance Choice and Pharmacy Advisor will help them differentiate themselves from their other competitors, and they expect to see growth there. But one of the biggest growth drivers for them are their specialty pharmacy. So once again, CVS has the largest specialty pharmacy in the United States, but the specialty drug market is actually the fastest growing segment of the pharmacy industry. And as you can see, just from 2014 to 2015, CVS's specialty drug revenues increased by $10 billion. So as you recall, the TRICARE deal was, the loss in revenue was only gonna be about $2.2 billion. So their specialty drug segment should more than cover that. They're a leading Medicare Part D provider. They still believe that they'll continue to add members to their SilverScript program, and they're also the largest retail clinic provider. They're the only PBM who will offer reduced copays at Minute Clinics. So over the last 5 years, CVS has captured 39% of all of the new prescriptions that were added into the market. So they are growing their share of an expanding market. And since 2010, their retail prescription business has grown at twice the rate of the overall market. And in 2015, they filled about 22% of all of the retail prescriptions in the United States. They've added over 3,000 stores since 2007. And in 2015, over 1,000 of those stores were added as a result of the Target acquisition. And they actually expect that the Target acquisition will help them grow more, because currently only 5 to 7% of all Target shoppers get their prescriptions filled at a Target pharmacy. So that leaves 93 to 95% who would be potential customers for CVS. And right now, 76% of the US population lives within 5 miles of a CVS pharmacy. So once again, it's more convenient for them, and as they continue to be more convenient, they'll have more opportunities to grow. So I'm gonna hand it over to Austin, who's gonna tell you about our risks.
Now, if risk becomes an opportunity for reward, so there's a few opportunities for reward here as our industry faces these risks. The top risk and bottom risks are kind of included together. We have a highly competitive business environment. To explain that, our retail pharmacy competes in that area to keep contractual relationships with PBMs, to keep things going there, and our long-term care pharmacies compete in the geographical regions they operate in, and they've been doing great in that area because a lot more people are getting old. Now, if you look at the reform of the US healthcare system, in 2010, Obamacare, or Affordable Care Act, better known as, was passed, and while that's not fully implemented yet, a lot of the risk there comes from the uncertainty, but that goes into our compliance with a broad and complex regulatory framework. We are subject to regulations at the federal and state level along with local laws. The main problem there, as regulation increases as it has in the past, it becomes increasingly difficult to implement changes on our operation level. And now onto our competitive advantage, a little bit more positive. Our retail pharmacy segment operates in a duopoly, so it's just us and Walgreens, and there's a CVS every corner, so we're doing great there. And we're also a sticky business to our Caremark sector. As you look at that, customers have to fill their prescriptions through an insurance company that's included in Caremark's network for every recurring prescription if they want that prescription to be covered by their insurance. So they have to go that unless they want to pay a lot. You can also look at your supplier pricing leverage. As we are so massive, a lot of our suppliers' business comes from us. So if they decided to not do business with us anymore, it'd be hard for them to keep doing business. And then we even have economies of scale, as each additional claim we process becomes more profitable than the previous one. Now, to go into a qualitative review, we've already explained that we have a sustained competitive advantage, and Audrey did a great job explaining what we do, and is also not heavily unionized. But it does require some heavy capital infusion. That's just from all the acquisitions we've taken over the past 5 years, which we see as growth opportunities. It doesn't require much research and development, but our inventory can become obsolete. Because we're a pharmacy, we have prescriptions that have expiration dates. There have been chronic one-time write-offs in the past, but that's because of leases we've had to pay off, and a segment we acquired called Linens and Things that declared bankruptcy that we had to pay off in 2014, 2013, and 2012. Now everything else is green there, so that's obviously a positive. And you would not be able to make a competitor with $1 billion because we have a $103 billion market cap. And we have all those other sustained competitive advantages that at $1 billion couldn't make a recognized competitor. Now we'll go through our quantitative analysis. If you look at our gross profit margin, it's not the most attractive, but we believe that That's an industry average. But if you go to our interest percent of operating, a lot of that is due to acquisitions and debt. And same as our net profit margin, while it doesn't look attractive at face value, it's very consistent, and we need to recognize that's an industry average there as well. We meet our current ratio, but if you look at obligation ratio, it says 7.81 years. But if you look at it before the acquisition of Omnicare, it's actually 4.7. So that's just not meeting because of our acquisition in 2015. Similar story for adjusted debt to shareholder equity. We're really close there, but due to our acquisitions and debt, we don't meet that either. If you look at our return on equity and return on capital, we also don't meet there, but we're really close on equity, and this is also industry average here as well. We don't have any preferred stock, and the only other red that needs explaining is our CapEx, but our acquisitions are included in there. So that also explains our not meeting the threshold in that area. Now, if you look at our gross profit margin, I already mentioned our declining aspect of our PBM sector. So that's what's really affected that, but we are combating that, and it's getting really close. But while that decreases, it looks good because our net profit margin has stayed consistent in that aspect. It has dipped recently, that's just from some of that pressure, but if you look over a 10-year period, it's still very, very consistent, and as Dave preaches, consistency is key. Now, if you look at our return on equity, we're a little bit closer to the threshold here, really approaching it. But like I said earlier, a lot of this is industry average, along with our return on capital, which has been more consistent. Once again, consistency is key, so you can rely on that now. Now, to go to a little bit more positive aspects, if you look at our total shares outstanding over the past 10 years, they've actually decreased 26%. So as all these decrease, we as shareholders will get a larger piece of the pie each time. Then if you look at this, it's really attractive. Our revenues over 10 years have grown fourfold. So that's great to see that we're continuing business. And you go to retained earnings, that's actually increased fivefold over 10 years. So we are continuing to do more and more business. And now I'll hand it over to Chase for the statistical array analysis.
All right, so I'm going to walk us through the statistical array analysis, and I'm going to hit a couple of few key points. So dividends declared per share has continually been increasing. And our gross profit margin, as you saw in our graph, has decreased consistently for the last 10 years. I think it's down about 8% from about 10 years ago. But that can be explained because of our large increase in our PBM segment. If you look at some of our competitors, like Express Scripts in the gross margin segment, theirs is strictly a PBM company, and they're at 8% gross margin. So that would be able to explain why it's decreasing. Our net profit margin has been consistent with our return on equity, has been increasing, as you saw in the graph as well, for about the last 6 years. And that's partially due to debt. We have taken on a lot more debt, especially with the Omnicare deal. Long-term debt and long-term debt payable in 5 years, like I said, the Omnicare was about a $13 billion deal, which was, as you saw, our market cap's around $100 billion, so that's a 10% of our company, so that would be a large acquisition. Now, all our dividends are under the 60% threshold. Right now, we're at around 27, 28% maybe payout, and they're expecting to increase that to 38% in the next coming years, which is great because they're starting to give money back to shareholders. So now we're going to look at the DuPont historical. We take our total asset turnover, net profit margin, and financial leverage multiplier and re-multiply it to get our return on equity. And this just allows us to see how companies juice their return on equity. So you can see our total assets have remained very consistent since 2013. And our net profit margin has slightly decreased, and that's kind of because of the pricing pressure in the PBM segment, but it has been a very consistent among the markets. The financial leverage multiplier as well has increased, and once again, that's largely due to Omnicare. But this has given us a return on equity of 14%, which is nothing to laugh about because 15% is our threshold, and that is right on the verge. DuPont competitors, we're going to compare against Walgreens, Rite Aid, and Express Scripts. So Walgreens is more of our pharmacy retail competitor, with Express Scripts being the largest player in the PBM network. And Rite Aid's a much smaller player, which has a very small footprint in PBM, but they do a lot of pharmacy and retail as well. Walgreens has announced that they are expressing interest in acquiring Rite Aid, which would make an automatic duopoly between CVS and Walgreens in the pharmacy retail. So for the total asset turnover, Rite Aid does have the highest, but we are right there between second and third with Express Scripts. And for the net profit margin, We're right there again. We're in second place, which is great. We might not be first because we do operate in the PBM, unlike Walgreens does. And then the financial leverage multiplier, we are in second place again, right behind Walgreens. And when you look at return on equity, we have 14%, which is very comparable within our industry. And Rite Aid does have a 21% return on equity, but that can easily be seen that their financial leverage multiplier is 18, so they're heavily juiced by debt. Now we're going to break it down in the industry compared to the same competitors. As you can see, our market cap is very comparable to Walgreens, and our revenue is by far the biggest player. So if we look at our price to earnings, we are the cheapest among the industry, and by far, as well with our price to books and enterprise value to earnings before interest and tax. And price to sales, we're right there in the industry average. With our return on assets in second place right next to Walgreens. And our return on equity, like we just saw, is very comparable within the industry. But our operating margin is the highest. We're at 5% with a net margin of 2.96%. So now an issue that we have acknowledged is our debt. We do have a lot of debt, as you can saw, that takes around 7 years to pay off. But if you look at this graph, you can see between about 2030 and about 2043, we have a lot of opportunities to refinance our debt. If you look at our coupon rates among there, a lot of them are around 1 to 2%, but we do have a few big coupon rates about anywhere from 4 to 6%. There's about 5 upcoming coupon rates. So those would be great ones to refinance to lower our rates and to pay out longer term in the future. And this graph here shows us our debt maturity schedule on a easier way to look at it because it's year by year. And the positive about this chart is that they don't have any large sums of debts on back-to-back years. So that gives them 2 years to build up capital to pay off this debt, or even, like I said, they can refinance in the future. It might be even 3 years before they have a large amount of debt to pay back. And they have such strong cash flows and earnings that it shouldn't be an issue. They have a cash flow recently of this last year of $9 billion. And now Kristen is going to talk us about the value bands.
We use value bands to determine whether or not the current price of the company is it's trading for a fair value compared to the historical evaluations of the company. And we begin with price to earnings. Now, when we evaluate this graph, we consider anything between or below the green lines to be undervalued, and anything between or above the red and yellow lines to be overvalued. Now, in price to earnings, we see that we're approaching undervalued, which is good because that's where we'd like to buy. Price to earnings growth, we are also approaching undervalued. Price to owner's earnings, we're extremely undervalued. Price to sales, we are also undervalued. Price to cash flow is extremely undervalued. Price to book is fairly valued. Enterprise value to revenue is approaching undervalued. And price to free cash flow is the most undervalued that it has been in the past about 10 years. Enterprise value to earnings before interest and taxes is fairly valued. And enterprise value to earnings before interest, taxes, depreciation, and amortization is also fairly valued. Now we go on to the discounted cash flow model. The discounted cash flow model is another method we use to evaluate whether or not the company is trading for a fair price. The discounted cash flow model takes the earnings per share of the company, projects it forward, then discounts that back to the present value, determining whether or not it's trading at a fair value. Now, when we look at the Guru default of 11.5%, we receive a 2% margin of safety on the fair value of the stock. If we use Value Line's estimate of 12% earnings per share growth, we get a margin of safety of 5%. Now, looking at the reverse DCF, we see what the company would have to grow out first to get a 0% margin of safety, or to buy the company at exactly the fair value, and that is 11.11%. Now, if we use the trailing 12 months growth to project, to use in this method, we get 5.4%, which gives us a negative 46% margin of safety. However, it's worth mentioning that we do expect the company to grow at about 10% according to management. So now on to step for the conscious investor.
So the Conscious Investor Report is another way that we see the return that we could potentially get on a company. So in order to do this, we are going to take the historical earnings per share and sales per share growth, project that forward in order for us to see what type of rate of return we can get on our stock. So as you can see, there is a historical growth rate as well as the stagger. And the stagger is a stability rating which illustrates how consistent the growth rate has been over the period of time. So for the 10-year period, the growth rate of the earnings per share has been approximately 11.5% with a stability rating of approximately 95%, and the sales per share growth rate has been approximately 12% with a stability rating of approximately 96%. Okay, looking at the 6-year period of time, we can see that the earnings per share has a historical growth rate of approximately 14%, and with a stability rating of approximately 97%, and the sales per share has a growth rate of approximately 14% with a stability rating of approximately 97%. And then for the last 3 years, the historical growth rate has been approximately, for earnings per share, has been approximately 11.25% with a stability rating of about 98%, and sales per share has grown at approximately 13.8% with a stability rating of approximately, 100%. So we use the 3-year time period growth rates because that was the most conservative as well as having the highest stability ratings. So we are going to perform a stress test on CVS to see if things go bad for CVS, what we can expect as a return. So first we cut PE by approximately 28% and growth by 16.7%, and we will see a rate of return of approximately 7.72%. Next, we're going to cut PE by 43% and then growth by approximately 48% in order to get a rate of return of 2.7%. And lastly, we're going to see how far we can cut our PE ratios and historical growth rates in order to break even on our investment. And in order to do that, we would need to cut the PE ratio by approximately 55% and the growth rate by approximately 61%. So now we're going to look at the interportfolio valuations, and we do this because we recognize that there's opportunity cost involved with investing in CVS, rather than investing in a company that we've already identified as predictable and consistent and are currently holding in our portfolio. So first we're going to look at it on a price to earnings basis, and you can see that CVS is probably upper middle for the current price to earnings metric, but if you look at the 5-year price to earnings range, they are the most undervalued compared to our portfolio. Price to earnings growth is a similar story. They are one of the more undervalued companies compared to our portfolio. Price to sales is similar. They are one of the more undervalued companies at our current metric, and then the most undervalued for the 5-year range. Price to cash flow, again, similar story. They are probably in the upper middle of for our current price to cash flow metric, but for the 5-year price to cash flow range, they are one of the most undervalued companies compared to our portfolio. Price to free cash flow, again, one of the more undervalued companies compared to our portfolio. And so in conclusion, there's been a lot of disparaging news about CVS, but we see a company that their retail pharmacy segment essentially operates in a duopoly, with Walgreens being their only formidable competitor. We see a company that has economies of scale, as for every additional prescription filled, they are able to spread out their management and inventory costs. In a sticky business, both with working with suppliers as well as their customers. And as Audra talked about earlier, we see a lot of growth opportunities, 2 of them being our aging population and our specialty drugs. So while we see all this, we recognize that it's not about where we would like the stock to be priced at. So we would like to recommend a put option with a strike price of $72.50, a premium of $1, which would put our which would put us in at approximately $71.50, and the expiration date of January 20th, 2017. And with this, we would be in the 20th percentile for our price to sales, the 30th percentile for our price to earnings. We would be approaching our 30th percentile for price to book, and then we would be in our 20th percentile for price to free cash flow. And before we open the floor for questions, we'd like to invite our analyst, Corey Cunningham, up to join us.
Mr. Zarodka, fire away.
So you guys talked about CVS buying a Brazilian business. I was just wondering, does the company have much of an international presence?
Not too much, but they are they're in Puerto Rico as well, but they're mainly in the United States.
Yeah, so almost all their revenue comes from the U.S.?
Yeah, pretty much.
Okay. With that being said, according to some of the recent reports that I've seen, it appears as if CVS may be actually decreasing its store count. I'm not sure if any of you have read about that or if you'd like to comment on it. But in addition to that, with CVS and Walgreens snapping up a bunch of independent and even some larger chain pharmacies, how saturated is the pharmacy market, do you guys think, in the U.S., since that's really where they're based?
Considering most of the population is within 5 miles of one of these pharmacies, or multiple of these pharmacies, it's pretty darn saturated. I don't think they need to be building too many stores.
But I think there aren't as many pharmacies that are operating in the specialty drug segment, so I think that really separates CVS from a lot of the other pharmacies, because their specialty pharmacy is so big.
Okay.
So.
Okay. Any reasons for the decreasing store count? Do you guys know?
I mean, if you look at Valuation, it shows a fairly big decrease. I think we discussed this. I mean, we looked at our growth. A lot of the growth did come from acquiring the Target 1,600 stores.
Mm-hmm.
I think they are closing some of the CVS stores, but they are also opening some at the same rate. So they're really not, they're decreasing some of them, but they're also opening at the same rate almost, that they are staying fairly stagnant in the CVS stores.
Any other reasons? Oh, go ahead.
No, recently they started opening up several standalones. Recently they've been starting to open up several standalone stores in Colorado. I think most of their stores had been connected with Target, and Walgreens had a pretty strong presence there, and so now they're starting to open up standalone stores. So I think maybe closing some stores and opening others might be strategic on their part. It doesn't look like it might just be that a store would be better used for operating, be able to work more efficiently in some locations than other locations.
Okay. Thank you.
So in the interpretation of financial statements, there were some issues. You talked about the debts and, well, it doesn't pass right now, but there was a big acquisition in there, and maybe that gets pared back in the next couple of years with normalized earnings. We'll see. But there were a lot of issues on the interpretation of financial statements right now. Return on equity is whose favorite metric?
Warren Buffett's.
And did it pass at any time over the last 10 years?
No.
So that's a red flag for me. And so my question is, why are you willing to make so many exceptions, especially when these are important metrics to us? And the other one was specifically about the gross margin. You can say all you want about the profit margin being along the lines with the industry average. Okay, well, maybe it's not a fantastic industry, but what's happening to the gross margin as well? There's a lot there, sorry.
Okay, yeah, so the first question is, why aren't we worried about the return on equity? So we owned Walgreens before, which is their strongest competitor, basically. So you have CVS and Walgreens, and you can see that they both have a very similar return on equity. I don't think Walgreens was ever over 15%, but they basically just compete against themselves, so they have a lot of pricing power in their segment. And then to reflect on the gross margin, Walgreens' gross margin isn't decreasing like ours. Theirs actually is kind of increasing. But if you look between Walgreens, who doesn't have much of a PBM segment, compared to CVS, and our strongest PBM segment, which is our strongest competitor, is Express Scripts, we have a gross margin right in between them, around I believe our gross gross margin is around 16-17%, when Express Scripts is at 8%, and Walgreens is in the 20s. So when you combine those two entities, you can see that the two of the top players are very consistent among them. So I'm not concerned necessarily on the interpretation of financial statements not meeting those. In the net profit, like you kind of made a comment about that, it is at 3 or 4%, but we also are in the retail industry, which if you go look at any retail company, Walmart, the major players, they all have lower margins because it is very competitive, but our convenience helps us.
Thank you. I do have one follow-up to what you just said, unless someone wants to add on. There was one competitor, it's a fairly consolidated industry, but there was one competitor that was left off that I was surprised it was not brought up. Does anyone know who it was in the competitive analysis? Yes, go down there. Mm-hmm.
They said that their largest, or their main competitor in there was Pharmacia, which was their, well, but it's a really small company, so we didn't decide to include it.
I think the market cap was about 700 million, if I remember
Okay,
right. So
that's not who I'm thinking of. There's three big PBMs, CVS Caremark, Express Scripts, and a segment of United Healthcare called Optum RX. And I'm pretty sure looking at Optum RX might have helped compare as well.
Okay.
When you're doing a competitive analysis, that would have helped. But
Also in recent news, Optum RX and CVS are actually talking with each other in order to do a partnership in order to help. What it does is allow Optum RX's members to use their pharmacy for several of the 90-day prescription plans. The partnership between them is to help both of the companies. So I think they're kind of mitigating that kind of competition by talking with each other and doing things together.
interesting, thank you.
So you guys have already spent a fair amount of time talking about the pension benefit manager, or pharmacy benefit managers, sorry. And you have discussed the fact that gross profit margins have been declining. So you've got declining gross profit margins, and you took on a whole bunch of debt to do it, which obviously makes your organization more at risk. Do you think that the PBM was a good decision? Why or why not?
I think it was a good decision. We are the second largest player in it, in the PBM segment. I believe we have 24% of the market, so that definitely helps us boost. And the gross margin's a little bit lower, but the net profit margin of our competitor like Express Script is still in our 3 to 4% range, which is very similar to our pharmacy. So it helps us create more of a sticky business because we're more of a one-stop shop. I don't know if y'all like that at all.
I mean, I think it definitely diversifies CVS, and because none of the other pharmacies that are that size really have their own PBM, I think that it makes it easier for CVS to, do business, and they serve more customers that way.
Yeah.
So they have a bigger customer base, probably.
To second that, just going to CVS to pick up something and then realizing, oh, you've got X, Y, and Z that you also need to pick up. And sure, they may be a bit more expensive at CVS, but you're already there. It's just another way to reach more people, which is never really a bad thing.
Okay. Mr. Nelson.
When you look at your intra-portfolio list and you see the CVS's on the low end, how many of those companies
have seen that industry-wide in the pharmacy segment since Donald Trump has become president. Some people are kind of worried maybe about the Affordable Care Act. So there has maybe been more of a buying opportunity in pharmacy because they've all dropped significantly in their price because people are scared. So regulation, that could be an issue, but I wouldn't worry about the government regulation as heavily because people are going to still need medicine and people are still going to have to pay for medicine. These companies aren't going to operate at a loss because that would not be possible.
You're right, but your stock may sell for a lot less than you pay for it if they're operating at a much smaller margin. So, I guess the follow-up is, there's been a lot of, the presidency aside, there's been a lot of time spent on Capitol Hill over the last year with kind of some high-profile manufacturers, pharmaceutical manufacturers. They're getting the brunt of the complaints right now with some of these massive increases in prices, but it is shedding some light on the industry as a whole and the amount of middle persons in that industry that tack on price. It's a very complex system. So do you have any concerns about the complexity of the pharmacy delivery system within the U.S. healthcare market?
I think there are some concerns. I know recently Aetna has been trying to acquire Humana, which would be a big deal. And there's another, Cigna's looking to be acquired, I believe, which are two of the largest health insurers. If these went through, Aetna would be the largest Medicare D part insurer, and that means they would kind of go away from our PBM segment, which they do make up a large segment of our PBM revenue, but I believe in the 10K it says that no PBM customer makes up more than 10% of our revenue. So we could potentially lose them as a customer, which would show that these insurance companies are going to cut out the middleman. But the Department of Justice has actually blocked both of the deals because there'd only be 3 major health insurers in the entire United States. So I don't think that's going to happen anytime soon, that they're going to cut out the middleman. And as well, Aetna has a contract until 2019 to use our PBM segment. So that gives us at least 3 years of playroom, and Department of Justice seems like they're kind of against the health insurers joining so that they could make a stronger PBM segment. Because if the insurers did make a PBM segment, there'd be a huge monopoly on all the steps of pharmacy.
So you feel as a group that the valuations right now are an overreaction to concerns?
Yes.
And fortunately for CVS, which we talked about these prices being so high, it's mentioned in the 10K that they're trying to fight these prices, especially in their PBM sector, because that's where the declining margins are. But what they've been doing more, and they mentioned this in their 10K, is they're talking to more generic brands and name brands to get a better purchasing pricing and better discounts and rebates, so they can then pass that on to their clients to help those margins as well.
Yeah, this is a very specific question about just one portion of CVS's business. But Audra, you were talking about SilverScript, and it seems odd to me on the chart that you had where you said they're an open network, the largest open network, and it just seemed very odd to me that CVS would be an open network and allow customers to go elsewhere.
Well, they're going to get money from, I think because it's more convenient for their customers to go wherever they want, they're going to get a portion of the money that I guess Walgreens would get as well, because they are, they're paying, they're providing the Medicare Part D coverage.
Okay.
I don't know if that makes sense.
Okay. I don't know. I don't know if I'm really looking.
For their convenience. And
Okay.
they're trying to make it more convenient for customers, because then they will want to be SilverScript members.
Okay. Okay.
Mr. Thompson.
I may have missed it, but was there something specific you saw that said these guys are gonna increase their margin?
What margin are we talking about? Net profit, gross margin?
Net profit, yeah.
Net profit margin?
Yeah, because you got about 3 things going against you there that make my blood run cold.
I don't think, we can look at our net profit margin
kinda like a little bitty bullet hole in a canoe just above the water line. It's not a big deal until you go down just a little bit. Then it's a really big deal, because you got more competition coming. The press and everybody's talking bad about you, saying you make too much money. I mean, you got competition growing, you got government getting in the act. Man, I'd be wanting to cover my head. I wouldn't want to have any, I wouldn't want to be on thin margin. I guess what I'm saying, and I'm hoping you saw something that said, you know, we're doing this, and business is gonna be sweeter. Oh,
I mean, I personally saw the opportunities for growth that they are looking to enter, as well as their numerous competitive advantages to protect them. And that's what caused me to vote for present CVS.
What are those opportunities for growth?
The prescriptions increasing because of aging population, the specialty drugs, as Audra talked about, that it's one of the fastest growing business segments currently in the pharmacy industry currently, and they are the largest player in the specialty drug segment of business.
And as Audra said, they locked down 39% of the new prescriptions of the last year. So if they keep taking that percentage of the market every year, they're going to continue to grow.
So as specialized as CVS is in that it just does prescriptions, it's also relatively diversified for its field, because you can't just compare it to Walgreens because it has more segments, and you can't just compare it to the one Rite Aid because it's prescriptions, because it has it does similar to what Walgreens does. So it's insulated itself in other ways.
I have a question about one of your slides, Stephanie, but anyone can answer. How is a price to earnings growth ratio, or a PEG, calculated?
Yeah, that was incorrect on that triple portfolio. It looked like, is that what you're asking?
Well,
Because it showed 1.5.
how is it defined first, and then we'll get there.
Price
I was
over
jumping to what
earnings
you're
per
reading
share.
out.
Thank you.
Growth,
Way to read minds.
right. Price
PE divided by the growth
Yeah.
of earnings per share moving forward. So your current PE is 15 and change? 15?
Yes,
Yeah.
correct.
So a PEG of 1 means that you're growing earnings per share at 15% a year. So I just wanted to make sure that we understand your assumptions of the company moving forward. So if that's incorrect, then what do you think earnings per share is going to be growing at?
Earnings per share, I mean, in the last 12 months, we saw 5, but they said that they predict 10% in the future years, and we have 11% consistency over the last 10 years, 5 years, and 3 years. So if we continue that, that puts our PEG probably about 1.45 or so, about 1.5.
Mm-hmm.
So that's still a great PEG ratio, especially for us to be such a dominant player. Like, we're already a big company. As you can see, we operate duopoly, we have a huge market cap. So if we can grow at that rate, that'd be awesome.
Thank you. And then I had a question about one of your slides, one of the value bands, but once again, anyone can answer. Why did you choose to start the dates of all of your value bands about 2007 or 2008? Is that for a reason? You've got data that goes back 30 years. I just wanted to make sure why you selected that date.
Because it's the most recent span of a significant chunk of data that would include the entire economic cycle. So it shows the possibilities of the company over an entire economic cycle, and you don't want to go back 30 years because then you're looking at a lot of data, and it's just not as meaningful as more current data.
Also, I think a couple of them did start about 2007, and that was because
some of the data
during
was terrible.
2006 it was an outlier.
Yeah, it was like stupid multiples more than the rest of the data, so that wasn't meaningful. So I took
Are
it
y'all
out.
asking why did we start in 2009?
No. I actually ran the value bands and I did it for the full 30 years. I actually agree with yours a little bit better, and it's not for that reason. It's because that coincides somewhat to the extent of the Caremark acquisition in 2007. So the business from that point moving forward is probably more meaningful. I was just curious if that's how you were thinking about it.
It was not.
Okay, well,
If you want to think it was.
I'll think that it was.
Yes, it is.
guys showed several different valuations that you looked at. Which valuation metrics are most important in evaluating this asset and why? Why? Why don't you put them up and tell me why?
Because of the cheapness. Price to ownership, I think, shows us how much we're investing back into the company, correct? So that shows that we're investing heavily back into our company, and as you saw, we do a lot of mergers and things along that.
No, press runs.
Yeah. Right there. Because we want to make sure we're making money and we're earning things, and we're doing well historically, well, relatively well, approaching undervalue.
But you showed me like 7 different valuations. Some of them have to be more important to this specific organization than others. Which ones are they and why?
I don't think,
I think price to cash flow is a big one.
yeah,
Why?
Because it's all about how much cash this company's generating. They generate a ton of cash, as we just talked about. They did $9 billion in this last fiscal year. That's a large amount of cash, so they can use that cash to reinvest into the company and give back to shareholders.
Okay.
I also thought it was kind of important to note that the enterprise value to EBIT and EBITDA was fair value, because they don't take into consideration the price. But like if you look at that, they're fairly valued. So when you take out the price, this company, I may have just but this company isn't as undervalued as it may have seemed on the other ones. So I thought those were pretty important as well.
And if we go back to price to book, that is the least important of the list. That's largely due because we don't own our land. We lease out, I believe, around 96% of our stores. So price to book basically has no, I wouldn't say no meaning, but has a lot less meaning than our other metrics. And so it is more of our overvalued segment.
Okay. Andrew, last question. John, you want one last shot?
Yeah, I'll do the last one. So you guys have specific metrics that you've developed, and you have thresholds for those metrics, where in general, if a company meets or exceeds those thresholds, you can say with a certain amount of some certainty that they have a durable competitive advantage. Well, you guys, on a lot of the metrics you showed us that they fell below the threshold, and someone, either Nate or Dave, touched on this before, that you kind of explained it away by saying, well, that it falls within the industry average. So I'm just wondering, at what point do you consider those factors and decide to choose a better industry, or go ahead and present or invest in this company instead? I mean, can you come up with some bullet points as to why this company merits investment even though it doesn't meet those metrics?
I think it's really because it is one of the best in its industry.
And just because certain metrics are what we've developed for, they're blanket metrics for almost the entirety of the stocks that we've looked at, but that doesn't mean they're meaningful to every single industry, because there are some industries where, like there's some industries like banks, and there are some industries like a lot of the data industries that don't have any debt, so most of our debt measurements don't really apply because they pass with such ease. So I think it's important to take into account that the industry, just because they don't fall under our specific valuations, that doesn't mean that it's a bad industry. It just means it's different, and we need to look at it differently. So considering that we have looked at it within the industry and that we have found an explanation for why it doesn't meet our exact threshold, or why it's close but not right there, I think it's a fair investment.
And another thing is, we operate in a duopoly in our pharmacy and retail segment. So there's only 2 options that you have to go to. So almost no matter what, you're having to make a decision between one or 2. So we don't have that many competitors. That helps with the segment because it's like you're going to be using us no matter what. It's like the banking industry. The network effect, you're always going to be using one of those banks. It's not necessarily a network effect, but it's such a sticky business because you have basically 2 options to use. And CVS is always like 1 or number 2 in most of their categories that they do business. So this makes it hard for you not to use CVS because they're so big and such a dominant player, and they're located on almost every corner. They have so many locations that you're almost forced to use CVS even if you don't want to. And with your insurance, if CVS is your insurance covers CVS, you're going to be stuck using CVS whether you want to or not.
Yeah, I think that's a big part is that their business segments improve each other. Because if you have Caremark, well, then you need to go to a pharmacy on their pre-approved network of pharmacies. And so that brings more business to the CVS pharmacy.
Okay.
Which makes it more convenient for you to get other things there.
I think the point where we would move on would be if, I think the point where we would say, we couldn't say that this was just an industry thing would be, like, we're currently close to number 1 or number 1 in our industry. If we fell below, like 3 or 4, we would have to say, like, well, CVS is not a good company. So even though we don't meet our metrics, we are still proved that we are one of the best in our industry.
We're a good company. We're not going to go anywhere.
All right, great. Thank you.
All right, let's give them a round of applause. Thank you, everybody, for attending on a cold, rainy Friday afternoon. This has been the end to a fantastic semester and continues to reinforce in my mind how important the Bulldog Investment Company program continues to be. When I see now finishing out 9 years and see where all the graduates have been, it tells me that it's something very worthwhile for each of you to have on your resumes. I thank you for the analysis and the in-depth thought and all the extra time that has been taken outside of class to put these presentations together. I think it's something that all of you should be very proud of. That said, the winner of our final competition for the fall is CVS. So I have some paychecks for the CVS team for your investment research. And I thank you all. I think it's going to be a fantastic spring semester, and I'm very proud of everything you guys have accomplished.
For more information, please visit tlu.edu.